Greetings, market rebels. Welcome to this week's macro measure. It is Sunday, August 27th, 2023, just about 10 a.m. here on the East Coast. I'm Wayne, and I'll be covering the macro situation as best I can in a reasonable amount of time. Let's do our quick flashes of our disclaimer and then our trusty intellectual property rights notice. And then we will flash the more important stuff, which is the streamlined stream of thought, stream of consciousness notes. And I'll leave that up there in case anyone wants to get a screen capture and just kind of have that maybe on another screen to follow along. But I'll put this in sector situation just as a reminder from where I'm really coming from right now. Just a summary background information. It's hopefully helpful. And then I'll just flash last week's stream, and you could see if you wanted to spot changes or so on and so forth, you could do that. But I think that about wraps that up. I'll get back over and we'll reposition things. So let me stop sharing here and let me move over to screen. I think I need to switch to screen 4. I need to switch to screen 4. And then we'll be back in business there. And I think we are sharing screen 4. And we are. So, yep. So let me just do this. So I've got to move that around a little tiny bit to get it positioned properly. So I'm starting out with just a quick review. And I can tell you right now that this week is going to be not a lot of wringing of hands. I'm not going to go into all the reasons why I'm really more neutral, kind of back to neutral, but you have to, I think, be concerned in terms of playing defense or going on offense to the downside because of what's happening right in the bond market. But this is for those of you that wonder why does he keep referencing this week after week, this third year of the presidential election cycle, the sweet spot and so on and so forth. It's just because of the historical performance, right? It's been relevant this year. So we noted this really heavily at the start of the year and kind of kept going with it because it's played out pretty well. We did come across it, of course, prior to that. And this sweet spot really starts in right before the last quarter of the year, when you get through the midterm year. Now, this is the pre-election year in the presidential cycle that we're in right now, but you could see that sort of around the October lows when we did actually bottom, that's about when this sweet spot rally takes place and runs its course into really through July, right? Early, just to kind of have a nice break point. So this is your pre-election year, the year we're in right now. You could see that's the best of all years, right, in terms of the performance of the S&P 500 right there. And so you could see as well, right, that we kind of get into it's magnified. What you see here is basically magnified here, even though it's slightly different data. But the idea is that I think it's slightly different data. But the idea here, of course, is that, right, we have this sort of swoon into August. It's kind of a rough patch. They try to rally again. That fails. Excuse me. They try to rally again. That fails. And then you have maybe the washout, the final washout, excuse me. And then by the end of the year, though, the gang doing gang things as usual, you end up, right, closing out the year on the highs. And it doesn't seem to me like that makes any sense. But, right, given what's happening in the bond market and the economy, but we don't really trade off of what we think makes sense. We really just always go with the charts in the here and now and do our best to stick with them and adjust along the way, because trying to figure all this stuff out ahead of time can be very costly. Would be one way to put it. So this is really the summary, right? The sweet spot's over. You should be in for a volatile period. And you can note that you just don't go straight down. And just because even the fact that, right, that the VIX picks up, which it has, right, kind of like just on time or on cue, it doesn't, even though the VIX tends to trade up into October, which you'd expect, right, given that October can be rough, a little rough on its own at times. And you can see that's really when the bottom typically gets put in. that makes sense that the VIX would peak somewhere in October and then start to back off from there. And we'd start rallying in the VIX a little bit as we did. Now, I don't know if the VIX holds the same place that it has traditionally. That's a big question that a lot of people are really arguing over. Some people believe it still does occupy that spot, the fear gauge. Others do not believe in that anymore because the VIX just seems like it's been suppressed for so long. And I wouldn't doubt that it is suppressed, but I don't know. I guess if we have a really serious another leg to the selling that develops, and we're maybe pulling back, I don't know, let's say between 15%, maybe 15 to 20% total from the Q high or the SPY high that we saw total this year, then that would be pretty, I think, concerning to a lot of folks if we had a whole nother leg that brought the total pullback from the highs down that far. And if the VIX doesn't react, then I guess you do almost have to retire it, right? What's going on that the market pulled back this much and the VIX didn't care the entire time, or at least start looking at other things a lot more seriously. But this is the, excuse me, the seasonal or cyclical analog that we've been going with. And we've stuck with this because it's worked out really well. We had this very strong rally for about 9 months. And that's really right in accordance with that sweet spot that we've been talking about in this third year, starting last year in the second year. And the other thing I would note for folks that are bearish, like me, in terms of the economic situation, right, and yields and so on and so forth that we'll talk about, is that next year tends to be the second best year of all 4 years in the presidential election cycle. So you got to keep that in mind, right? Because as long as this thing keeps working, it may just keep working. And so we don't want to be caught flat-footed and just, we don't want to be held hostage, right, from profiting from market movement as short and intermediate term traders, and some a little bit longer term traders with some of the services, but we want to be able to take that momentum and those trends and work with them and extract, right? That's what we're trying to do. So that's why we don't want to get too beholden to this stuff. Let's go through and take a quick tab review while I'm here, and then we'll sort of start summarizing things a little bit and then get to the charts. So what I would like to display is the fact that why I'm having a hard time get started here, right? Whenever I have such a hard time coming up with some kind of a lean, and I'll review last week's lean and all that, it's because you're in a spot where it's obviously less obvious, right? It's not so clear cut. And right now we've corrected in this percentage stocks above the 20 SMA, okay? And in a big way, you can see, and we noted that there could be a double top, it could roll over from here, could go higher, but definitely, right, you're in the zone of where this thing typically corrects from. We got that, and now you're approaching the zone where it typically bottoms. There's just right around here, there's bottoms that have developed, and we've seen big reversals from. So you're not all the way at the lowest lows, but you're getting down there, and you don't have to go to the lowest lows. I still think, right, in my mind, it would make sense that you do, but that doesn't matter, right? The market doesn't care about what I think. So I'm looking at it saying, like, look, it's kind of getting there. Like it might be there. So we can't ignore that, right? And if we look at the 50% of stocks, right, that are above the 50, that's also had a very large correction. Now, that does probably suggest that there's a little bit more typically to go down. I would say probably, yeah, you probably should expect a little more corrective activity there. So what does that mean? Does that mean the market has to go down? Well, I would say no, because probably would be easier to achieve, right, that kind of oversoldness, if you will. But you could have a lot of stocks weakening under the surface, and you could have the gang working their usual brand of magic in levitating some of the big players. And so the market does just fine. Meanwhile, a lot of stocks under the surface are deteriorating, right? That's happened many times. The same is true, but probably even more so for the percent of stocks above the 200. Should you expect to see more of a pullback? I would say probably you should, at least a little bit more of a pullback in this. But this could worsen while, again, the gang is doing the great camouflage work that they do, right? With the rotation schemes and all the stuff they're able to pull off. Go mine those mega caps, levitate those, that kind of stuff. So you get the idea. I don't want to belabor that. Now, interestingly, we talked about this last week, but you'll notice, right, that there's this changed a little bit, I guess, on Friday late when I didn't catch it, maybe I thought I was updated, but the point is that really you're still, if you look at where we are current target rate right now, you can see that we are in a situation where there's nearly, let's say, a 56% chance that we go up by some degree by November. That's where the market is right now. So once again, I'll say it this week. I've been saying it for months, but that means that interest rates not only went higher, but could still go higher and remain higher far longer than the perma bull crowd that was crowing about how rates were about to top out late in the winter, early spring. And that just hasn't happened. I mean, that's completely been dashed. Reality, forced upon them. But as you know, right, the market's been pretty impervious overall so far. I think we only had about a 7% pullback in the Qs and 5 or 6% pullback in the spiders. So not anything, right, that's extraordinary, just kind of a solid pullback, which market needed. So that might be all that you get. We'll see. Neutral right now on the fear and greed. So you really can't say that they didn't pull this back enough or in a way. Notice, right, that we were down in 43 on the prior close. So that's that. Here's the timeline, right? So could you fall more? Sure. Would I expect it to fall more? I would expect more, but I'll show you why it's not a lock, I think, before we wrap up. And then finally, this is one reason I think it's not a lock. It's because notice, right, how over the last, really over August, notice how over here on the bearish side is up dramatically. I mean, you're up nearly 80% in terms of going from 21.3 to 35.9. So not the net amount, but the percentage change from 21 to 35.9 is a dramatic move in terms of bearishness now. So you're more bearish than you are even on average. You're less bullish than on average, right? You're just about the neutral factor is just about where you are historically, but it's definitely tilted more towards the bears right now. And as a lot of you know that watch what we do every week or weekend, this is contrarian, right? So that's that, and that is that on the tabs. So I don't think we need to belabor the tabs any longer. What I would like to do, though, is go back and let's cover some things on the slide. Let's see if I can get, what can I do here to maybe shift over back to, let me minimize this and stop. I'll switch my share to a different screen. We will share screen number 1. That ought to do it. So I'll share that again. So I'll just cover a few things here. So I noted that we should expect, this is a review and summary of last week, really. And wait a minute, did it move on me? No, I'm my bad. I left it on last week, so that's my fault. I apologize. I must have forgotten I'd done that. So let me get this to show better. Okay, there it goes. Okay, so yeah, you all ought to have that last week's bottom line. So we were expecting more of the same. We expected more corrective action potentially, but we also noted that the SPYs and Qs came in short-term oversold, and so we thought they have more room to fall if they want to in the big picture, but that there could be a rally. And what we noted was that between those conditions, the catalysts of NVIDIA and Jackson Hole, that's what we thought would be the best things on the calendar in the short term for the gang to orchestrate a rally, and they did. Right, that's what we saw really through the early part of the week. So they moved them back up, and we'll see that. But they've got the 50, the slowing 50 and the declining 20 really got in the way technically. And then we got the sell-on news that we were speculating maybe could happen, where because they jammed Nvidia so much and it's this big shiny object that they could then sell into it. So that reversed the early part of the week shenanigans. Friday was on the cusp of fulfilling, like I would say, fulfilling what was our most likely scenario if we had to force one, and that was that everything that we just covered happens, and then later on in the week, when those catalysts are done, they don't really deliver anything extraordinary for bulls potentially. Then you get hit hard and you roll over for that second leg of corrective activity. Well, that was happening. All the sectors were under pressure early, but suddenly the market reversed. Now, this reversed with the dollar remaining strong, and really with yields, the TNX, for example, hanging in there and kind of correcting and holding above a support level that we noted during the week. So to me, this was hard, because if you're a day trader, fine. But it was sort of like, I'm not sure what really reversed that, other than, was it expiration related? Was it, the typical defense, not letting a lot of puts kick into the downside that would have turned the situation ugly? Was it the thinness, right, of a late in the week, late in the summer type of environment? Was it a combination of all that? I don't really know. That's the bottom line. I don't know, but it was a little sketchy. And when I see that, right, it's hard, because that makes another part of this week hard, because what are we doing here? Was that real, or was that just nonsense? And I can make an argument in both ways. I have to say, though, a lot of these, what I would have called nonsensical things many years ago, decades ago, to me are now holding. Like, in other words, the Friday BS seems to have at least some Monday stick-to-itiveness. So we'll see. I'm just saying in general, I don't really know what happens, of course, on Monday morning. But anyway, the result of all these shenanigans and what happened is that there's something for bulls and bears to take away. But I would go from DEFCON 1 to DEFCON 2, right? Which means, instead of like you're playing defense or you're ready to play defense, you're playing defense or you're ready to play offense to the downside, you're kind of waiting for more weakness or critical things to happen. But what I would do, and I'll show this, is I'll use that swing approach, right? I would use that swing high, swing low approach. In other words, the recent range. And if you start to see breakouts above there, you start to see breakouts below there, then you can start to trade that breakout, knowing, right, that a lot of breakouts are false breakouts, at least initially. They don't always just go straight through and roll on, right? So you've got to be smart about handling these kind of breakout trades, especially when the market is not really that decisive, or there's no really serious driver out there. I mean, to this point, you'd say, well, aren't rates a driver? But they should be, I think. I still am in that camp, but they've done a great job of ignoring rates. And let's talk about that current assessment. We did the brief tabs check, the bond yields, and Powell talking. What happened last week, I think it made things more concerning. We just saw what happens in the interest rate market, I should say bond market, rate expectations, excuse me. So to me, if this continues with yields moving up, that is really something that could ultimately break the equity market. But it's always in the timing, right? We could start to say, well, for sure that'll happen, but A, it's probably not a for sure, and B, it's probably, okay, let's say it's very likely. When does it happen? These guys are the masters of doing things on their timetable, not really on the timetable that a lot of folks would expect, myself included, right? When I think something should happen doesn't mean it always does. And that's why I wouldn't trade off of what I think should happen, right? I did way back when, and then realized that, like, wow, this is not operating according to what the textbooks and professors have to say. But anyway, the bond yields, the 2-year, the 5-year, the 10-year, these yields have really held up. They're either just off of recent highs, or in the case of the twos, they made new highs that haven't been seen since 2006. So think about that. That's really, really, really a long time ago. So, and my reminder would be that, right, everyone that wants to see these cuts, the real carnage begins once the Fed starts to cut historically. It doesn't mean it has to happen every time. It's just that when the Fed realizes they need to get rates lower, it's usually too late and the economy is already in a woeful tailspin. And usually you start to see recessionary developments, and the market quickly discounts that. And by falling pretty quickly at that point, and then once that selling's over, that's usually when you have the shot at the real the emergence of the real next, bull market. So we already saw the 3rd-year performance. I still don't see these large catalysts in the short term for why you would rush in and start buying equities with what is happening in the bond market. But the stocks on sale, perma bull crowd, right? They don't really wait around for that. They may just start buying anyway because we didn't fall, and they think they're now getting a 6 or 7% discount, right, to where we just were. And remember, they think there's a bull market coming, and they may be right. I'm just saying that I'm still in doubt, but they may be right. Breadth measures, right? These things are not really looking clear. There's some things that look like, no, there's more to go. And other things look like, well, the momentum's starting to shift back positively already on some breadth measures where they're coming in for things already a little bit. That has to do with last week. So you already know the next line about the DXY and TNX. The zigzagging that we just saw on some of those 3rd year of the cycle graphs just mean this could take months where we could be up and down. It could just be a trader's market. You take what you can get and you're happy to do it. However, we're still at risk of an ugly monthly candle. So we could, I don't know why it's not, my cursor wasn't showing on there, but we're still at risk of an ugly monthly candle. So this is a problem, I think, right? That if you do finish this month poorly, that could bring about more selling over the next couple of months. And then probably they'll try to orchestrate something, unless the wheels really come off and they have no choice and the selling pressure is too great. We've been wondering about the bear market rally or leg down. I think that's going to become the new talk, right? If we move lower more than bounce around in a range, if we move lower and you have that real pullback, then a lot of people will start doubting that a real bull market really is about to unfold the way a lot of people have convinced themselves of that. So we'll see. I mean, I still think something could really unravel. I think I'll show this, play the swing range. There's more room to fall if they want to, but there's also more room to rise. And that must have typo corrected. That should have been, sorry, that should have been more, that should have been more room to rise. So I don't know what happened on that one. So sorry about that. Again, I'd stay at DEFCON 2. I still think there is more corrective action on the way. If at some point soon, both the TNX and DXY continue to power higher strongly. I don't think the market can keep ignoring that to the degree that it has. I just don't, but I could be wrong on that. So we'll see. I'm still, again, having a tough time buying with the perma bulls. Perma bulls are selling. I just don't see a lot of key factors that are supportive of the market. But I would say that a couple things have started to, that are maybe like under the surface, a little bit longer dated. They've started to perk up and suggest that there's maybe a lot of the weakness we've been seeing, like Philly Fed, that there's other things that are sort of flipping back the other way a little bit. We'll see if that sustains. I'm not so sure with rates, mortgages, auto loans, all that kind of stuff being where they are, but we'll see. And then these are just the general reminders that, again, like if you weren't sure and weren't a believer about what the gang does in terms of using the calendar, I don't think there's many weeks that were better. I mean, this was flimsy to really rally an entire market on NVIDIA, since they're clearly this leader and they've got this technology that everybody wants now. How that turns out to be this incredible thing for every, not every, but you get the idea, every other stock out there, to me is absurd. But that, again, it doesn't matter. That's just what creates the mood creates the sentiment. But again, news can be made to trump charts, and we're just going to trade what's in front of us, because that's what it's about. Plus, the path is what we have to get right, and even that is hard to do, right? So that's why we just resign ourselves to the fact that we're going to do the best we can, and it all comes down to being a nimble and really a sharp position manager. That's what it comes down to in the end. And I think a lot of people learn that after a while. So having covered everything thoroughly, let's stop the share. And then what I'll do is I'll get into the charts and we'll talk about the charts, because I don't think we need to belabor even the charts all that much. So let me do this. So first of all, I'm going to show the SPY. So get me the right screen number 3. There we are. So here's the SPY. And again, I apologize, but this is one of my cleaner charts that I've got right now. And excuse me, because there's a lot of mess out there, I think. And that's usually what happens when you have a lot of mess, is you've got a lot of different techniques you're trying to pull in that maybe you don't use all the time, or at least leave up all the time, just to get an idea on what's happening. But on my charts, the 20 is that light blue SMA, and the 50 is that gold. And you could see, this is what I was talking about in terms of the SPY. They just stopped it in its tracks right there. This was the sell on news of the NVIDIA, the NVIDIA jam job. This is a really ugly reversal, right? That really undermined the entire week at that point. And this to me, at least early on, with all sectors under pressure, with the dollar up, with the 10-year and other yields either not backing off or rising somewhat, I thought this was going to test this level here. But they did not allow that to happen. And the reality is, if we're honest about it, they managed to get, out of the 12 sectors on my 12-sector grid, they managed to make, let's see, let me double check, 11 of those 12 finished positively, after I would say 9 or 10 of them were definitely negative early on. So they came in for everything. And these kind of sketchy, dubious, I would say orchestrated saves have carried over for at least another day. Whereas, like I said, 20 years ago, I would have said, that's bogus. It doesn't have any lasting. That'll unravel on Monday. And usually it did. But that's what I'm saying. Like, we have to adjust to what happens here. And for now, right? For now, the honest look at this is shorties rolling over. You're below the 50, not good. You have a declining 20, not good. However, your 100 in dash white and your purple 200, these are still upsloping. So those are the long-term trends. The intermediate term being the 50s, about to flatline if it hasn't already, right? And so you've got the shorties battling the long terms, and the 50 is just sort of about to flatline. So it's very tough to get a really confident read. If you go a little further, just with some simple techniques, and you look at this and you say, well, what's the RSI on this particular view is the red, and kind of like a red colored one when it's overbought. The green color is when it's oversold, and kind of like that vanilla color is when it's neutral between 30 and 70. And or might be 65 and 35 actually on this. So my apologies, but you get the idea. Anyway, the point is that the momentum is not so bad right now because of this save. And so I don't want to start pounding the table that, hey, this thing's about to fall apart. I do think it has the potential to do that at any point. And I do think you could get a whole nother leg lower that takes you down to the 200, closes some of these gaps, maybe not all of them, but I do think that could happen. But, right, we have to be on guard, because these guys are excellent at what they do, probably the best in the world, and that you just can't rule out this attempt to string another rally together and even come back and close this. I don't know if that would happen right by the end of the week. You'd have to move up a heck of a lot to do that. You'd have to move up by 4% this week from where we closed, just to get to near this gap closure, roughly speaking. So that's a tall order. I don't know what would cause that. It would probably be some sort of news that a lot of us are well, definitely unaware of, but probably aren't even anticipating. And that would allow them, with a lot of people hating this market still, that would allow them to, with the new shorts that they pulled in, really put it to them. The other thing we should note is that there's a 23.6 retracement of the October low to the late July high. So you stopped at really the first fib, which to me is something you've got to give the nod to the bulls as of right now, because they could have allowed for more retracement and they didn't. That's pretty much the most shallow retracement level that we're going to get on the fib retracement grid, if you will. So what you do with that, I don't know yet, but it is notable. And they also have a possibility that they could be playing games here, and you may have maybe a very obvious head and shoulders, very obvious slightly compound head and shoulders where we rally, we fall, and then we rally from here, we fall again and roll over, and you kind of get this like almost like double shouldered mini shoulders. So you could get that. At the same time, you have to say, well, they have this higher low in for now, and if they start taking it through, right, then there could definitely be some more upside that they work with. So that's what I mean. I think you have to play this game of, if it gets above that 50 for now, or you could use the high from Thursday, or here. These are the two levels, and inside of there, I'm playing whatever the momentum is, I'm playing that game. If they around the calendar, right? Keep that, whatever is coming out, keep that on your radar to know how they might move stocks around it. But I'm going to just kind of trade that singles doubles mentality until we see something return. Now, if you see yields climbing and the dollar's not backing off and it's climbing, and then this thing's rolling over and sort of paying attention, I guess you would say, paying heed or giving heed to what's happening there, then you could finally have another breakdown. And obviously you would test the 100 first, right? We think there's going to be a flat line somewhere near 431, 432 anyway. That's another pretty big level from the past. So I would think that may matter should we get there again. They didn't quite let it get there on that day. It only got to 433, but again, it's pretty darn close. I wouldn't quibble too much about that. But then, right, if you start to see the dollar rising, you start to see yields continuing to rise, and this thing rolls over. Yeah, I think that's what you've got to keep your eyes on. I mean, just very simply, trade the range. If the dollar, if dollar and yields are not doing much, you can't get a good read on it. Just trade the range. Probably if they're not doing much, that'll more than likely be an excuse to rally, because they're not, when you're in this longer term bull structure and sort of mindset, it seems like they'll use any lack of bad news to try to rally, and that's just been my experience. So as long as those things do not hurt, probably, right, all other things considered or not considered, I would lean towards the fact that they'll try to rally in the face of yields that are just churning, let's put it that way. But overall, I think you've got a situation where, with market breadth being what it is, you have to say it's close to correcting a lot, not quite there. And that's why it's hard, because if they corrected it more, I would say, look, they're probably, and we had a whole nother leg down, I'd probably say, look, you have to expect them to attempt a rally sometime soon, because that's what they do. I mean, that really is what they do. Now, looking at the SMH, Ryan has different lines than I do. I think he's got different scaling going on than I do. But this is what I was trying to get to last week in a couple of webinars and cocktail hour. And this is the SMH. And this is really obviously a very important sector. And so I was using this as a support line for this channel that was up here. But we broke below there, and that was something I was waiting for. And that really opened the door to the next round, right, or of selling, or the next significant drop. But then this acted again as resistance now that we're below it, and they sent this packing. So this is another thing I would watch this week, would be, how are these semis behaving? And you can see that there's probably other gaps we could go back and find that I don't have on this particular chart, but you get the idea, right? Like that puts you just about down to your 200. Now, if that were to take that path. So if they lose support here, they lose the 100. It's probably right a real serious sell-off, and that gets worked down. Probably at that point, I'd start paying attention to that gap. If that 100 gives way, then you probably want to say, wow, that gap could matter, and that could be a good reason to keep rolling down all the way down. So just keep that in mind. That to me, it has lost a little bit of its luster. I don't know if it's totally done. I have a lot of things telling me that thing's really on the brink of having some rough stuff, but it hasn't cracked yet. And that's why I think that if they manage to pull a bullish rabbit out of the hat on the last week of the August in August, then that's going to probably give them a chance to save it better. So I think this week's important in probably determining if we have a nice little 3, 4, 5% rally coming up, or we have that whole nother leg of selling, which could really, again, take us down pretty significantly. I mean, I would think that we could drop between, I would say, another 5 to 7% from where we are now in SMH and the spiders, and things along those lines, the Qs naturally as well. But this is just one of those things where this is why a lot of times I'll leave old lines on my chart, because they do end up coming back and mattering, and it was helpful in that case. And now you've got the lower high put in there, and I think you have to be concerned. I don't know what the catalyst would be for this to just be wonderful given what's happening in the world economy, but again, that doesn't have to always matter in the short run. Let's look at the Qs, since that's really where we're at in terms of spiders, Qs, and the SMH is being really important itself. And the Qs, right, it's very similar to the SPY. I mean, I don't even want to really belabor that. Very similar. Hard to like things, but let's be honest, right? The long terms are still looking fine because there hasn't been that much damage. And you've got a slight improvement happening in terms of the momentum because of last week. And really, they saved that. They took something that was on its way down, and they were able to again save it. And you don't, again, it's hard. You don't want to read too much into one day late in the summertime, and especially an expiration day. But at the same time, like I said, the recent trend in my mind has been they managed to do more with that than meets the eye. Like it has more staying power for at least another day or two. So once again, I think you may as well focus on the 50 SMA in gold up there, which is near 370, which is about, a little less than 2% away. And you may as well focus on this low, which is the 354, which is about 2% away, ballparking it. So 355. So otherwise in here, you might just do, look at this 23.6 retracement there. Look at the action inside of there. That's what I'm talking about, where you get swings inside of there that you can trade. So that's what I would focus on for now, as opposed to thinking all hell is about to break loose. And the only caveat to that statement would be, well, the typical news, right, that you just comes out of the blue that could be big, geopol, whatever. But the other big news would just be if the dollar and yield just keep ramping. And that would definitely, I would be surprised if they're able to just, again, continue to ignore things. But you can see those charts are just very, very similar. And I think there should be another leg of corrective activity, but it might require a little bit of a rallying first. And you never know, they could end up doing more with this rally if it does come than we would expect right now. If you're like me and you're kind of like a rate bear, basically, I guess would be the best concise way to put it. I'm just a rate bear in the sense that I think if rates continue to go up, which they could do, that this market is diluting itself. But maybe I'm deluding myself. Oh, I wanted to get that line extended. So a good a good area to come up to if it would let me, and it won't. Geez, that is just super frustrating. I think this is part of the planned obsolescence. You run a computer for a couple of years, spend a lot of money to buy good components and build your computer. It's all running like a champ and keep everything updated and all the drivers, all the operating system, etc. And despite having more than enough firepower, you end up with this sluggish performance. And then Thinkorswim might be in on that that little scam. But anyway, I would think, look, they try to bring this thing up to here. There's a flat line right near there. It happens so often that you just can't be it can't be a coincidence, right? When you see it so often. But yeah, I think your 375 number would be where there'd be trouble. Now, if they get it past there, it's very easy to come back and fill the gap, right? At that point, they only need like another 1.5%, and they close this gap. And like I said, with the third year cycle, the way we saw it earlier, you really can't rule that out. You can't say, no, there's no way that happens. Actually, it makes a lot of sense that would happen, in a way. So you've got to be on the lookout for that and not picking too big of a fight too soon. Again, if that does that with yields continuing to roll higher, I would be in the Phoenix portfolio, if you're not in there already, asking Ryan for his take on how you can position yourself beyond that, because that to me would be more fantasy land material. Let's be thorough. Let's look at a couple other things here. IWM, right? This is a great trader. It might not have looked like much, but there was, even last week, there were really good trading opportunities. And again, if we're honest about things, which we try to be honest and objective about them, you have this lower low. This is a tremendous possible washout, flush out, possibly. And this is what these guys do: barely exceed lows or highs, and then they start reversals, which they did on that day. And I'm getting really sluggish performance. There you go. So you can see that the RSI and some of these other indicators are showing that we're getting a little bit of a momentum flip attempt, right? Where they're trying to better themselves, or the action's sort of bettering itself. It's holding on to that 200-day. Remember, these are your smaller companies that should be more sensitive to interest rates being higher, because they don't have the massive balance sheets that the mega caps do. And so higher rates to them are more painful. So you can see that there's a very clear resistance line, basically where the 10 SMA is in white, which is another way of saying, why not just play like last week's highs? There's a flat line near there anyway. That's about 186. But if they get through there, they're going to hit SMA resistance. But yeah, they could definitely move this back up to the 20, right? That wouldn't be crazy even to do that. And that's going to put them right near 190, right? So you could get a nice, if they keep rallying from here a little bit more, you could probably get another 2%, roughly speaking, from that point on. Excuse me. And like I said, things are a little bit better where they bottomed them out here. They double bottomed it here, and they've got basically some positive divergence. Now, here's the thing. This is all nice and slick, deftly handled as usual. But remember, should things change, it can change very quickly here. This could change very quickly here. And clearly, this isn't as strong of a spot in the market as, say, the Qs have been. So this could be below all the SMAs very quickly. And it has a gap here. It could go back and look to fill. This could all shift around very quickly. And this is what some people that I think that are newer, that don't realize how important being nimble is when it comes to trading. They think, well, you sounded bullish. Now it's 2 hours later and you're bearish. Yeah. And that's how there's certain junctures where things can change that quickly. This happens to be one of them. We don't always see this, but this happens to be one of them. There's some nice elements, I think, in place there, but I don't think that you really want to start counting your winnings. This thing's going to lift towards that 50 and 20 confluence area up there near 190. I think it could. It could, right? If the market's managing to pull it off, if rates are not hurting the cause, maybe rates are going down. There's nothing that says rates have to go up, just because I think they are likely to, but they might take a breather. right? And if they do, I would expect these guys to make the most out of it. Diamonds, let's look at them. They're not really that great of a trader, like a lot, but sometimes they are. Worth noting, but see, similar situation where they're trying to put something together from oversold. They've done this before. If you look at this low here, and then you look at this other low here, which is similar, right? You have momentum slightly improving the second time around, and they run with it. So they might try to at least run up a little bit towards that 20. We'll see. Again, I would be very, because of the long-term picture, I'd be just as happy to trade the downside if this thing starts failing as rates are ticking up. If you start to see that TNX get somewhere north of that high that it made early last week, and it's, say, instead of 43.6, it's trading 43.7 or 43.8 something, I would expect these things to start getting under pressure again, with rates, maybe finally making their way to that 44.28 on the TNX that I've been looking at, which we may as well bring up here because I talk about it enough. I should bring the dollar and TNX up, but this has been my concern for a while, and I think it was very fortunate that we were latching onto this and focusing on it more and more lately with what we do, because you could see that this was in this churn phase, right? This sort of basing consolidation, and it's been working its way up, and you have to pay attention to that if you're me, at least. And well, that's all the data I can get right now. I wanted to get a little bit more data in here for us. Hold on one second there. Okay, well, it's not cooperating, but right now you're at a level that's up towards here, right? So you're up towards some of the highest highs, if not a higher high that you've seen in a while. Like that goes back to October, right? And so we were at much lower stock prices. And here's my long-term resistance line that you can see. This takes the last 5 years of the 10-year yield. And if you manage to keep going and kind of fulfill your destiny, you're going to trade up towards 5-ish on the 10-year rate, 10-year yield. So that would be, I think, very detrimental to the equity market, in my opinion. I guess I'm an old timer that thinks interest rates still matter, but I have a really hard time thinking that interest rates don't matter. So I'm sticking with it for now. But that's what I'm getting at, is that if this thing does really break out, I mean, I think it's big trouble, and you could have a real serious sell-off. So my main projection is 44.28. Like, I think that's the more realistic one. And it got most of the way there, but then we've had the back off. But if you notice, it's kind of held above this former resistance point. So it's sort of holding support, converting it to support right now. And if it does manage to start going up, we'll see. It could double top, could put in a lower high, could put a false breakout together. I mean, I know I'm talking about it like it's not a yield, but you get the idea. Trying to think if there's any, oh yeah, let's cover the dollar. So the dollar is another thing that, again, I would keep your eyes on. It's concerning, right, that you have the strong dollar. It's all these mega caps love these with a weak dollar situation that makes everything cheaper abroad. Well, we all know that in reality, they American companies have made it a policy to hose Americans at the highest prices they can. And meanwhile, if you compare some prices of things in other countries, they're far cheaper. So there's, of course, if you had a legitimate media, there'd be a ton of coverage on that. But since that's also fully captured by the same perpetrators, basically, you don't get that coverage. But here's the dollar, long-term downtrend. It's been going on really, right, since before the stock market bottomed. And now they're working it back up. And I think it's got the chance to keep going. I would think on this one, I think you're going to go to about, I would say, yeah, you're probably looking at about 105. I think it's going to be somewhere near here. It would be the realistic, near this area here. To, let's see, maybe Yeah, probably really this 105 level here, like I've got 105.136 would be just about where I think is a realistic projection. Then what I do is if it gets to my, I think what I call like the realistic or reasonable expectations, and then it just keeps showing strength, I'm willing to go with it. You know, especially from a rolling perspective, when I'm charting something, I'll keep rolling as long as it, you know, it continues to go. But then you've got to just keep the overbought, oversold factor in mind, and how like how old something's getting. And I think that this was really a great illustration recently about, I think it was MPC that we were talking about a few weeks ago in terms of the rolling. And if you were willing to just continue to roll when something's working, it can really, at times, you can really get incredible performance out of these rolls. And there's barely any look back. Now, this is rare, but it does happen. So that's what I mean, like where I'd keep my eye, sure, I'd be keeping my eye on the exit when the RSI gets up towards 80 and then 90 and all that. But again, the idea would be just keep milking that momentum, and then you really just want to lose on that last final roll, and you're okay with that. If they don't back it off and you keep rolling, you can really make out like a bandit. But I think those are the main things. I mean, there's really not a lot to say. I probably should just flash the VIX up here for us, but I don't think anything special is happening in there right now that we can really latch onto and say, oh no, the VIX is, you know, this, look at this. When it does this, it does well. I'm not saying it's in a terrible place. I do think it has a little potential the way it looks, but I can't really get super excited about it at the moment. I would be a lot more excited if it starts moving back up towards these recent highs, you know, near 18. And then it would maybe like, okay, this is getting where this thing hasn't been there in months, and it could finally start doing something. And it is looking a little bit better after basing. I get all that. It is the time of the year, right, where we would expect the VIX to continue to try to work its way up. So that's good, especially like in this third year of the presidential cycle, the way that things play out with volatility. But the way that it closed on Friday, naturally, given what they did with the market, was pretty ugly. So I guess a lot of people learned their lesson. They've conditioned people not to go long the VIX over the weekend. And so at some point when there is a really serious correction, they'll get everybody closing their VIX longs out and regretting on a Friday and regretting it the following Monday when they put the final whoosh lower together, and people see volatility explode that day. But that's how they do it. They do a lot of conditioning, and then the old wild card gets pulled out when they need it the final time. But I think on that, I'm just going to wrap, because I think we covered the main stuff. And I think, again, you're more about the range right now, trading the swing high, swing low, knowing that there's a lot of mixed signals in breadth. And I think you just keep focusing on bond yields, keep focusing on the dollar. And if those continue to power, then you start going from DEFCON 2 to DEFCON 1.5. And then you start seeing those lows break and rates scream. Yeah, you probably that's probably at least the start of another leg, or at least it's the higher chance that it's the start of another leg lower. But if you don't get that and you get the opposite, again, remember, these guys are the masters of making the most out of nothing, right? So don't be surprised if after us having corrected for really nearly the entire month, not quite, but nearly the entire month, they put a little more shenanigans together to keep these bigger picture charts looking better. So on that note, I'm going to wrap up. I hope something that I share with you helps you out this week or another week in the future. I'll be recording sector situation soon, but that's going to be a lot like this, where there just isn't going to be that many, I think, interesting or salient points that we can make right now, because it's the market juncture. And just remember, the way we look at things, right? The market is your environment, and a lot of things are subject to being in that ecosystem. And so sometimes the actual market just spills over into the sectors with risk on or risk off. And sometimes there's independent action. And lately, it's been more risk on, risk off. And that makes it tough to really say, hey, this sector's emerging, let's get ready to get into that, or this sector is really flashing some deterioration, like we may want to either get out of it or become a put side player, that kind of thing. But it is what it is. We can only report what we see. So again, hope this helped you out. I want to wish everyone a great week ahead, and thanks for tuning in.